Inflation is running absolutely out of control. Hey everyone, welcome back to this week's edition of the Vancouver Life Real Estate Podcast and YouTube channel. Ryan and I, freshly back from Orlando, Florida. We went to the EXP Shareholder Summit conference down there. It was 37 degrees. It was very nice to see the sun, the heat, and to be honest, very, very exciting and inspiring to hear about where this brokerage is heading, where they're at now. So we're back here with a fresh energy, and we are here today to talk about, well, a lot. We're going to look pretty national today, and we're going to start off the top with what's completely, probably top of most people's minds here, the highest inflation print in 40 years. Inflation came in at 7.7% just last week. This is up from 6.8. We're almost up a full percentage point month over month here, and yes, this is the highest dating back to 1983. If we break it down into a couple of the most predominant sectors here, you got groceries up 10%, gas 48%, and shelter 7.4%, which we all know is vastly underestimated there.
And if I may, CPI, I mean, it is not a great indicator of inflation when you look at gas up 48% and you're seeing inflation numbers at 7.7%. I don't know. Doesn't add up to me.
Well, sure. And shelters, we know, closer to 20 to 30%, depending which part of Canada you're in. So with most people buying groceries, filling up their cars with gas, and living in a home, those three alone push it upwards of in the 20s. But again, take that for what it is worth. All right, so what does this mean? Where are things going to go next, and how bad is it going to get? Well, first let's talk about the overnight rate here, because of course interest rates are going to be affected directly here. The steep trajectory for the overnight rate implies that the 5-year fixed mortgage could reach the 5% level for the first time since it was back in 2009 was the last time it was that high. And variable rates, they're going to be about as high as 4.5%. With the stress test in place, that means qualifying right now is upwards of 6.5%.
Oh,
that could go to 7% very soon.
Oh.
So think about people qualifying at 7%, whereas at the beginning of this year, the qualifying stress test amount was closer to about 4%.
Yeah, and I think the last time that we saw rates like that, house price averages were in the 900s. So you can imagine what that might do to prices. There is an active move towards eroding wealth right now from the Bank of Canada. And generally speaking, one interesting stat that we're looking at here is when you actually speak to affordability, Dan, the average British Columbian now pays 58% of their household income towards shelter cost. Right? Back in 2000, for example, that was closer to 35%. So the big thing here is also wages haven't kept up in that time frame, right? So as we continue down this path, it gets scarier and inflation becomes far more pervasive. And honestly speaking, mortgages in terms of an 80% loan to value, the payments are up by about $1,000 in 9 months. That's enormous. That's an increase of 60% on average, right? And by comparison, from 2016 to 2021, almost 6 years, the increased on average by about $500. Whoa, that should put the brakes on some people's decisions because it's getting out of control.
Yeah, I mean, affordability has been talked about here in Canada, and especially BC and Ontario, for at least the last 15 years. Really come to the forefront in the last 10 or so. But you got to think, early 2000s, homes were, like Ryan said, about $900,000 on average. That was the last time that we saw mortgage rates in and around the sevens kind of thing, at least for the qualifying. Now, take your average home today here in BC, that's about $450,000 higher, and apply that rate. This is where we're talking about, when the household income and the percentage of it that's going to just covering your housing costs, it's starting to, you can kind of get the idea here that something is about to break. Like the cracks are imminent right now.
It certainly feels like it, also just being on, the front lines and seeing it every day. The conversations that we're having, people are really trying to balance waiting out the market now for prices to come down versus paying higher interest rates and where that new equilibrium is going to be. And quite honestly, maybe one of the only good pieces of news that we can pull from some of this information is that the 5-year bond yields have backed off quite dramatically, from 3.6 down to 3.4%. That should help, at least in terms of 5-year fixed rates. It should put the brakes on them in terms of going up at least a little slower. I don't know if it'll cap yet, but it'll be a little bit slower, right? So maybe a little bit more price stability. But again, bond yields are a good reflection of the rest of the economy as well, right?
So inflation, 7.7 here. Bank of Canada, their next rate announcement, is on July the 13th. Top economists, they're betting to the tune of about 90%. They feel that they are going to see a 0.75% hike following what the Fed just did last week. This is going to obviously push everything else even further higher. Now, that said, because of this inflation print being so high, banks are really kind of baking in this expected announcement already. So it's not like you're going to see a spike that day. You're going to see the increases happen from now until then.
Yeah, and I also think that that's really sort of a really good indicator of how people are feeling too. And you got to remember, we typically follow the states, right? So down in the states, they rose by 0.75% just recently. It's very, our economies are inextricably linked. So you're likely going to see us follow suit just because we have to. The effective household interest rate too, the average interest rate paid across all debt jumped 28 basis points and is now the highest since 2009. So it's now sitting around 4.3%. Through the pandemic, we were looking at closer to 2.5%. So dramatic increases there too. Dan, do you want to talk about the markets and say maybe how much money has been eroded in the last 6 to 9 months?
Yeah, so on top of everything becoming more expensive and the money that you can borrow is more expensive to buy these things that are more expensive, thanks to the stock market and what's happened basically year to date with especially the NASDAQ, the crypto market, it's estimated in around $15 trillion has been erased, year to date here, about 6 months in, $15 trillion.
I don't even know how to fathom that. I don't even know what that looks like. But what
it's a few countries.
Well, yeah, that's the thing, right? That's the big thing, is that this is on a big scale, big scale. This is not a small problem. This is soaring inflation that is pervasive throughout the economy, and that is going to have a real negative wealth effect. And I think that's kind of what we should talk about, kind of going forward here. Is what is that going to look like?
Yeah. So what do we do? What do people do in this environment? Well, typically, when you've kind of come out of this incredible bull run, especially the last 2 years where, housing's up 30, 40%-ish, and people are feeling wealthy, which is essentially the wealth effect. It's your general consensus you're feeling about wealth. And if, sure, the average BC home is up $300K in 2 years, people are feeling wealthy. They're out there buying things. And when the market shifts, the exact opposite happens and people pull back. So the things that you're not going to see getting purchased right now are more luxury items and your more frivolous items, if you will. Things like, boats, cottage cabins, watches, this type of thing. It's already being noticed, just like the same way we watch the housing market very closely, we kind of watch the car market as well. As you all know, if you're trying to buy a nice used car, in the last year or so, prices are 30-40% higher than they were a couple of years ago, and the selection is next to none. Well, that even is
higher than new cars.
Yeah,
used
that's right.
Cars are more expensive than new cars, which is bananas. But anyways, sorry, I cut you off.
No, but that's the point. Is it's been inexplicable in a sense, and so again, what we're seeing is that shift. So these things that typically were hot ticket items as recent as 5-6 months ago are now starting to hit the market. So we're seeing more boats for sale, more cars for sale, this type of thing. And the trajectory of that is going to increase, especially by the end of the summer here. Obviously, because rates will be higher, but also people are probably going to try and get that one last use maybe out of their boat, out of their cottage, whatever it is. And then you're going to see an offloading come fall and winter of these type of properties and again, luxury items.
Yeah, these assets, especially the depreciating ones, right? I mean, you're going to start to see price corrections and inventory climb just like we have in the housing market, right? As it becomes more expensive to credit these purchases, people tend not to buy them, and they tend to protect their downside risk, right? At least that's what they should be doing, and that's kind of the intention of raising these interest rates, is to have that psychological effect on the population, to slow down the demand and slow down the buying, right? We've got to temper growth in order to bring down inflation. And that's done primarily through interest rates, right? So, but not all sectors are going to be affected in the same way. First of all, I think it's important to recognize that national prices, right, declined for the second month. So this is the first time since 2019, and they're down by almost a full percent, by 0.8% as of May. Now, what's going to be really interesting here is to see where these corrections and the size of the corrections take place, right? Commuter cities, for example, in Ontario, that are above 1 hour from downtown, prices are already down 14%, right? Is this going to move into BC? Of course. How could it not, right? So with the rising of interest rates, you start to see this pendulum effect. We were swung way too far to the other side too. So, it's nice to see this kind of come back a little bit, but I don't think there's going to be quite a soft landing as maybe the Bank of Canada seems to think they can do.
This is like reminiscent of 2016, 2017. Remember when West Van was so incredibly hot, especially the luxury market? That pendulum swung way, way out and things were so overheated. And then, of course, when it swung back, that was the property type and the area that got affected the hardest. They saw the biggest downturn. So now we're seeing a very similar thing happen in the suburbs. Toronto's already seeing it. Vancouver is as well, with places like, Abbotsford and Chilliwack. The median over there dropped hundreds of thousands of dollars in a couple of months. Yeah, this is huge. And again, they were rising at almost a similar pace. So not too surprising. The overheated areas are the first to fall, and they're going to fall the furthest. Yeah, I mean, it's not like the neighborhood increased in value by 50%, right? Or 33% or 40%. Honestly, what happened is the flow of capital became so much easier to get that it just pumped more liquidity into the market, and that allowed people to spend faster and more often and more money. But when the pendulum swings and quantitative tightening starts to take place, you realize that a lot of that increase is frothy, right? And we're seeing that now. We're seeing that correction start to take place. Yeah, the one data point that's super interesting is, of all the decline prices happening right now nationally, where we're seeing the deepest cuts are in properties that are around 55 to 75 kilometers from the downtown core. And this is both Toronto and BC, or Toronto and Vancouver, rather. So, again, we're talking the suburbs, right? When you could work from home during the pandemic, you'd run out and buy that home that costs the same as your, let's say, near downtown condo, and go get a 3-bedroom house for the same price out in the suburbs because you wanted space and you wanted some land or whatever the case may be. And now people are getting obviously called back to work. We've been saying this for a long time, but this is just the now proof of it, if you will. Yeah. And this is real wealth erosion, right? Especially if people get caught, right? That's a difficult thing. There's some of these purchases where people went out to the suburbs, having paid, higher and higher amounts. They might get caught out there and having to stay there now for some time until those neighborhoods do improve, or until demand resurges, or until supply drops again, until we find another equilibrium. It's not going to be forever, because the demand for Canadian real estate, generally speaking, across the long term is still going to be quite high. But in the short run, this is volatile,
This is going to be volatile. And we're just starting to see this now.
Of course. I mean, like we just kind of touched on, when mortgages are getting more expensive, when rates are going up, obviously people are going to pull back, and they're going to pull back in housing as well. And this is very clear now with the data where, Canada, nationally here, we're talking sales are down 25% year over year. Inventory is going to climb. I mean, Ontario, again, is kind of the extreme and the first to kind of show the indicators here. Their inventory is up 37% year over year. Again,
Wow.
They had extremely low baseline, but still, you get an idea of where things are going here pretty quick.
Mm-hmm. Yeah, and then, like we said, the psychology of consumers now gets, it gets eroded. There's no confidence now, right? So people don't purchase things. Like back in the summer of 2021, we saw consumer confidence running around 66%, right? Now down to 50% and continuing to drop quickly. Furthermore, I read an article yesterday, or no, it was today, sorry. I'm pretty sure it was Globe and Mail, how 41% of Canadians no longer feel the Bank of Canada or the governor, Tiff Macklem, has control over inflation. They don't believe that he's going to be able to bring it down. Conversely, 46% feel they will, but that's about parity, right? There's one out of every two Canadians does not have faith in the central bank anymore. That's a big shift, right? Especially considering the last time we saw one of these really, really difficult, go back to 2008. One of the main reasons why we didn't fare as worse as the States is because we had a much more transparent banking system, right? And I think that confidence now, with inflation running where it is and having gone through the last 2 years, we're not seeing that level of confidence anymore. And I think that's because people are feeling it, right? People are feeling it in their pocket. So
I also feel too, though, like where was the confidence for the last 40-ish years when they did keep it between 2% and 3%? Typically,
totally
it breaks out for 6 months, and all of a sudden they don't have control.
Well, and it was a one-off. Well, it's a one-off event too. You had a pandemic too, right? So the pandemic there was a black swan event, if you will, despite the fact history tends to repeat itself, and we were due for one. Still, I mean, it's really hard to control how 30 plus million people are going to spend their money. I get that, but
for sure,
still.
Well, that's like you said, it's a great way to curb inflation is if you take people's wealth away. They're not going to buy. They're not going to be competing for things. Yeah. And so that's going to get it under control in due time. Okay, well, some other interesting observations here nationally. Job vacancies in Canada just crossed the 1 million mark.
Holy cow.
There's 1 million vacant job positions available in Canada right now. And yes, that is across the full spectrum of wages, from minimum wage up to much higher. Obviously healthcare, doctors are needed, scientists, programmers, everything. So full spectrum. This is a 45% increase in vacancies from last year at this time.
Holy
Massive
moly.
Jump in jobs. There's 9,000 vacant jobs in construction industry alone. People are trying to build, and they just can't because there's no one available. Renovations to multifamily towers. They cannot find the labor they need to build these homes.
Mm-hmm. Yeah. Furthermore, new homes under construction hit a new record high of 320,000. Will this help affordability? 120,000 of those are going to be rentals. So if you take those out, that leaves about 200,000 homes under construction. The average build time between 2 and 5 years. And CMHC is now saying, instead of the current actual target, which was 2.3 million more homes, they've now revised that to 5.8 million new homes. Though, expect this to likely to decrease as developers are pulling back, right? So, I mean, I think there's a real rock and a hard place right now. We've got demand surging in terms of new people coming into the country, and we've been saying it for years that they're just not talking to each other. How are we going to house the amount of people that are coming in? How could we not expect prices to have done what they have when you add it all up, right? So it's crazy.
CMHC's goal or target of saying, look, we need 5.8 million homes by 2030 in the next 7.5 years. That's just to start bringing down prices. That's not even really making them affordable. And yet, like we talked on earlier, Q1, record number of PRs admitted into the country. Q2 on target to beat that. I mean, through April, PR was up 64% over the year before.
Wow.
With international student admissions up 37% from this time last year.
Mm-hmm.
So, again, like we said, more and more people, less and less homes. Let's break it down a bit further here, Ryan. I mean, CMHC, okay, so they're saying we need, 750,000 a year completed homes to keep up with current growth patterns.
Yeah. Yeah.
Right now, we're building about 200,000 a year.
That's a major deficit.
Major deficit. Like, can you see the issue that's going to arise on the other side when inflation's under control, when rates start dropping again? Oh yeah, housing, still an issue. And it's all happening in the background. And here we go. We've got record high construction costs with no labor available.
Yeah.
Developers pulling back, lenders pulling back on major developments. But the people keep coming in.
Yeah, 1 million job vacancies, with one of the largest sectors being construction that needs the jobs that we can't fill for an amount of people coming into the country. I mean, this is a big problem. And I don't think that I don't think we have a grasp of how to get it done by 2030 when you consider the amount of supply chain issues that are taking place around the world too. And with supply chain issues delaying supply, further increasing demand, the cost that they think it'll take is going to go up too over time, right? A lot of these inflation numbers, some of them, I mean, I don't know if we're going to see energy prices come back down for some time. Right? Like gas prices are going to stay high for some time. It's something you can get used to, which sucks, but it's the truth, for obvious reasons, right? Being that, Russia is now no longer supplying a lot of the Western world with energy. So countries like Canada, we just don't have the production or the shipping methods to get it out to the rest of the world. These energy prices aren't going to go down, and that's going to make the shipping of materials, the shipping of people, the shipping of food, everything stays high, right? And that's the scary, pervasive nature of inflation.
Just a thought here. Like I looked to Whistler for a second there, and it's really become a playground for literally the ultra wealthy because it is just so incredibly expensive up there now, and it's like Canada as a whole is turning into this.
Yeah.
Like the ability to be able to afford Canada as a whole, especially, of course, East and West, being Ontario and BC, and especially Toronto and Vancouver. I mean, it's going to change the demographic of who can even technically live here over the next decade.
Absolutely. I mean, it's a major problem for major cities because, there's going to be, the average for a particular job is what you're going to earn, right? Well, if that is, your average property is 13 or 14 times the average wage, well, you're going to lose talent to other countries, other provinces. You get a bit of a brain drain when that takes place because the opportunities just aren't as good, right? So if people don't have the money to live here, they don't come here, right? So it's a problem in the long term if it doesn't get settled, or if they don't catch up. The other way to do it is having wage increases. I mean, 1 million job vacancies right now. I know we've talked on average that I think employers are wanting to pay people upwards of 25% more than they were 2 years ago for the same position. But, real wage growth is more like 3.5% to 5%, right? So nowhere near the growth in real estate.
That's it. Okay. To start to sum it up here, let's take a quick look at where people stand with their insolvencies because they're going to start ticking up soon. But today, personal insolvencies are basically still pinned to the very bottom. From pre-pandemic levels, they're still like 40% below that. We bottomed out in about Q1 of 2021, and it's just flatlined across the bottom since. But as we talked about, you can't have that stay forever when you've got the prices of basically everything going up. So let's look now at basically your non-mortgage consumer debt, your credit cards. That is jumping. People are using their credit cards again. The increase in April was the biggest since about 2013. HELOCs are doing this as well. People are tapping into their home equity more than they have in the last couple of years here. What does this tell us? People might be using credit to start to just stay afloat.
Scary.
Yeah.
Yeah.
Yeah, it is.
And that's just to afford the life that they were already living, right?
Yeah.
You know, and one of the reasons why we haven't seen those levels really start to increase yet is because it's going to take some time for the money that was pumped into the system to be drained out, right? That's what's taking place right now. We're just running along this bottom, but like you just said, there's going to come a time where people are going to run out of money, or at least run out of credit, and then insolvencies and things like that are going to change if they don't get inflation under control by that time, which I'm not sure they will.
It's already being seen in the business world first, prior to personal, and especially in the construction industry. Construction insolvencies are up 41% year to date.
Holy cow.
Why? Rising costs of materials, labor shortages, supply chain.
Yeah.
And what is this going to do to housing down the road? This gets passed on. Or, again, people pull back on building because it doesn't make sense to the bottom line. They run the pro formas on today's costs, and they're like, I'm going to lose money if I build this. I'm going to wait it out. And we're going to see a lot of this. So more people, less houses.
And that puts a whole lot more pressure on the bank and on the Bank of Canada and on the government, right? It really pins them in a difficult position. But ultimately, I think, consumers need to slow down their spending. And I think if that does take place, remember, a lot of inflation is psychological, right? A lot of how we control inflation is based on what we buy and how often we buy and how much we pay for it, right? So if people slow down their purchases and demand can slow to some degree, and people can maybe try and save a bit more of the money that they've had over the last couple of years, whether that's been through the government, whether that's been through housing increases, however they've made that money, slow down.
Okay, well, that wraps it up for us this week. Thanks, as always, for watching, listening. Is it time to buy? Is it time to sell? Is it time to panic? Is it time to do nothing? It completely depends on you and your personal situation, and we'd love to help answer that question for you. Look, give us a call, give us an email, even if you're just curious and have no interest in actually buying or selling, but want to know what it would look like for you. We're happy to walk through all these scenarios. So www.thevancouverlife.com. Thanks again, and have a great day.